All right, let's dive in. Today we're taking a deep dive into Prudent Corporate Advisory Services Ltd, Prudent Corp for short. You've sent us some pretty interesting stuff, and we're going to help you break it all down.
Yeah, it looks like you're really interested in getting a handle on their financial health, right? So we'll be focusing on their revenue, profitability, and of course, all those important financial ratios.
Exactly. Now, for anyone who might not know, Prudent Corp has been a major player in India's wealth management scene since 2003. They do it all, from mutual funds and insurance to stockbroking. Basically, they help people manage and grow their wealth. But the big question is, how's their own financial health looking? That's what we're here to find out.
So a good place to start is with their recent performance, especially their second quarter results for FY25. They saw a pretty big jump in revenue, like 51%. Now, keep in mind, that number includes all their subsidiaries, its consolidated data. Still, 51% growth is nothing to sneeze at.
That definitely catches the eye. And their profit after tax, the PAT, went up even more, a whole 69% increase. Looks like they're not just growing, but they're doing it profitably. But what I'm wondering is this kind of growth sustainable?
That's the question, isn't it? A 69% jump in PAT is amazing, but it makes you think, can they really keep that up? To get a better idea, we should look at their EBITDA.
Ah, EBITDA,
Yep.
the one that always trips me up. Can you give us a quick refresher on what it means and why it matters?
Sure. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Think of it as a way to see their core operating profitability. It takes away things like debt costs and accounting stuff, giving us a clearer picture of how well they're running their main business.
So it's like looking under the hood to see how the profit engine is really running.
Exactly. But we need more than just the EBIT number itself, right? What we really want to look at is their EBITDA margin. That tells us how much of their revenue is actually turning into profit from their operations. Ideally, you want to see that margin staying steady or even growing. That would mean their profitability is keeping up with or even beating their revenue growth.
Okay, I'm following you. Now, something else that stood out to me from the data is their trade receivables. They've been increasing right along with their revenue, which at first glance seems like a good thing, right? More business, more money coming in eventually. But I have a feeling there might be a catch.
You're smart to be cautious. Increasing trade receivables can be totally normal when sales are going up, but it also means Prudent Corp is extending more credit to its customers, and that can be a bit risky.
How so?
Well, on the one hand, it can be a good way to bring in more clients, especially in a competitive market. But the flip side is it ties up their cash. They've already provided the service, but they're still waiting on payment, and there's always a chance some customers might not pay at all, what we call bad debt.
So it's a trade-off between potential growth and potential risk. Which brings us to another important piece of the puzzle, free cash flow, or FCF. This is super important for a company's long-term health, right?
Absolutely. Free cash flow is the money a company has left over after paying all their operating expenses and any investments they're making in the business. You can think of it as the company's financial wiggle room.
Gotcha. So more free cash flow means more options for the company.
Exactly. A healthy FCF gives them flexibility to invest in future growth, maybe develop new products or services, buy other companies, or just have a cash reserve for tough times. It also means they can reward their shareholders with dividends or buy back some of their own shares.
So if Prudent Corp's FCF is looking good, that's a positive sign for their long-term future. Now let's switch gears and dive into the world of financial ratios, starting with the famous price-to-earnings ratio, or PE ratio. Prudent Corp's PE ratio is over 70. Now, to someone like me, that sounds really high. Can you help us understand what that number means in the bigger picture?
A PE ratio over 70 is definitely on the higher end, even for a growth-focused sector like wealth management. What it means is that investors are willing to pay a premium for each rupee of Prudent Corp's earnings.
Why would they do that?
Well, it suggests that investors are super optimistic about the company's future earnings potential. They're basically betting that Prudent Corp is going to keep growing rapidly, enough to justify that high price tag.
So a high PE ratio could mean high expectations, but also maybe a sign that the company is overvalued. Definitely something to keep an eye on. Now, how about their debt-to-equity ratio? Our sources say Prudent Corp is almost debt-free. That seems like a great position to be in. Why is having low debt such a good thing, especially with the economy the way it is these days?
You're right, it is. Being almost debt-free gives Prudent Corp a lot of freedom financially. First of all, it means they have really low interest expenses, which is great for their profits, especially when interest rates are going up. And second, it gives them more flexibility to deal with uncertain economic conditions. They don't have huge debt payments weighing them down, so they can handle challenges more easily.
It's like having a financial safety net.
Exactly. They can focus on growing their business and making strategic moves without constantly worrying about debt.
Makes sense. Now, what about their price-to-sales ratio? It's currently at 21.7 times book value. That number is making me a little nervous. What are some of the risks that come with a high price-to-sales ratio?
A high price-to-sales ratio, just like a high PE ratio, can be a sign that the market is getting a bit too excited. Investors might be overly optimistic about future growth, pushing the price up to levels that might not be sustainable in the long run.
So it's another metric where we need to balance the excitement with some healthy caution. Okay, let's move on to the EV to EBITDA ratio, another evaluation metric. What can this one tell us about Prudent Core?
EV to EBITDA stands for enterprise value to EBITDA. Think of it as a way to compare a company's total value, including debt, to its operating profitability. It's really helpful when comparing companies in the same industry because it considers their different capital structures.
So to really understand what Prudent Core's EV to EBITDA means, we need to see how it compares to their direct competitors. What's considered good or bad can vary depending on the industry and the company.
Exactly. We'd need to check out the EV to EBITDA ratios of other big wealth management companies in India to see where Prudent Core stands.
All right, let's talk about the interest coverage ratio next. This tells us about Prudent Core's ability to manage their debt, right?
Right. The interest coverage ratio measures how easily a company can pay their interest expenses with their earnings. A higher ratio means they have more breathing room, less risk of missing those interest payments.
And since Prudent Core is pretty much debt-free, I'm guessing their interest coverage ratio is looking pretty healthy.
You got it. With very little debt, their interest expenses are probably tiny, so their earnings can easily cover those payments. It suggests they're in a good spot when it comes to managing their debt.
That's good to hear. Let's look at a ratio that focuses on how well they're turning their profit into actual cash, the PAT to CFO. Could you explain what this ratio shows us and why it matters so much?
The PAT to CFO ratio, which is profit after tax to cash flow from operations, tells us how efficiently a company is converting its net income into actual cash. A higher ratio means a smoother conversion, meaning more of that profit is becoming real cash flow.
And cash flow is what keeps things running.
You know it. Cash flow keeps the lights on, allows for growth investments, and gives them the flexibility to deal with surprises.
It's the lifeblood of any business. Speaking of important stuff, let's talk about ROCE and ROE. These two ratios tell us how well Prudent Core is using their capital. Can you break those down for us?
ROC, or return on capital employed, is a broad measure of profitability. It tells us how well a company is generating profits from all the capital they're using, both debt and equity.
So it's a way to assess how efficiently they're using all their resources to make money?
Exactly. Then there's ROE, return on equity, which focuses specifically on the returns generated for the shareholders' equity. This one is more important for investors because it shows how well the company is using the money invested by their shareholders to make profits.
Okay, so both ratios are important for understanding how well Prudent Core is using their capital. But the question is, are their ROCE and ROE numbers good or bad?
To figure that out, we'd need to compare them to industry benchmarks and see how they've been trending over time. Usually, higher ROCE and ROE are better because they point to strong profitability and good use of capital. But context is key, you know?
Right, it's all relative. Now let's wrap up this part of our deep dive with the asset turnover ratio. This one tells us how well Prudent Core is using their assets to make sales.
Yep, that's it. The asset turnover ratio measures how efficiently a company uses its assets to generate revenue. A higher ratio usually means they're getting more sales out of their existing assets, which is a sign of good operational efficiency.
That makes sense. But isn't Prudent Core a little different? They're in wealth management, so their assets are mostly financial, not physical things like factories or equipment. How does that affect their asset turnover?
That's a great point. Their business model revolves around managing financial assets, not physical ones. So we might naturally expect their asset turnover to be a bit lower compared to, say, a manufacturing company.
Interesting. So we can't just compare their asset turnover to any company. We have to consider their specific industry and how their business works.
Absolutely. To really understand how they're doing, we need to compare their asset turnover to other wealth management firms. That'll give us a clearer picture of their efficiency compared to their peers.
So we've covered a lot in this first part of our deep dive. We looked at Prudent Core's recent financial performance, their impressive revenue growth, and profitability. We also dug into some important financial ratios, pointing out both their strengths and some areas that need more digging. But we're not finished yet.
One thing that's really striking is the contrast between their PE ratio, which is sky high, and their debt, which is practically non-existent. It's a pretty interesting combination.
Yeah, you're right. That is interesting. It's almost like investors are super bullish on their future growth, but Prudent Core itself is being pretty cautious, keeping their finances conservative.
Yeah, exactly. Makes you wonder, are investors getting ahead of themselves? Or maybe Prudent Core knows something we don't. Maybe they're planning some big expansion or a major acquisition, something that would justify that huge PE ratio.
That's a good point. It shows why it's important to look at these ratios in context. You can't just isolate them. You have to consider the whole picture, the company's strategy, their competition, what's going on in the overall economy, all of that.
For sure. And that goes back to what we were talking about before, about how important it is to compare Prudent Core's financials to industry averages and historical trends. Numbers by themselves don't tell the whole story. To really understand their performance, we need to see how they stack up against other companies in the same industry and how they've performed over time.
Right, like comparing apples to apples to make sure we're understanding the data correctly.
Exactly. So let's say we look at their EBITDA margin. On its own, it might look pretty decent, but then what if we find out that all their competitors are actually doing even better? It gives us a different perspective, right? Maybe Prudent Core has some cost issues that are squeezing their profitability, or maybe they're intentionally keeping their margins a bit lower to gain more market share.
So those comparisons to other companies can really show us a lot about a company's strengths and weaknesses.
Oh, absolutely. And looking at historical trends is super important too. Let's say Prudent Core's revenue has been growing steadily for the past 5 years. That's awesome. But what if, when we look closer, we see that their growth has actually been slowing down recently? That could be a little red flag, a sign that their momentum is fading.
It's like a detective story, right? We're searching for clues, patterns, anything that might tell us something important about Prudent Core's financial health and their future outlook.
That's a great way to put it. And speaking of clues, let's go back to that trend we saw in their shareholding pattern. We mentioned earlier that promoter holding has been decreasing a bit. That's something we should definitely look into more.
I agree, it's worth digging deeper. Why would the promoters be selling off their shares? Does it mean they're losing confidence? Or could it be something totally normal, like maybe they're just diversifying their investments?
Hard to say without more information. We'd need to know more about those share transactions. Was it just one big investor who sold a lot of their shares? Or is it a more gradual decline across multiple promoters?
And who are the buyers? Are they big institutions like mutual funds or hedge funds? Or are they individual investors? Knowing who's buying those shares can tell us a lot about how the market views Prudent Corp.
Exactly. If it's mainly institutional investors who are buying, it might be a sign that they believe in the company's long-term potential. But if it's mostly individual investors, it could be more speculative buying, driven by hype rather than careful analysis.
So there's a lot we can learn from those shareholding patterns. It's a whole other layer of insight into investor sentiment and what direction the company might be heading in.
Right. And that's what makes this deep dive so valuable. It's not just about the numbers, it's about connecting all the dots, putting the pieces of the puzzle together, and building a story that helps us understand the company's financial health and their potential for success in the future.
So far, we've looked at Prudent Corp's recent performance, broken down their key financial ratios, and talked about why it's crucial to compare them to other companies and historical trends. We've also touched on that interesting shift in their shareholding pattern. Now, as we move into the last part of our deep dive, what are some key takeaways you'd like to leave with our listener?
Well, I think the most obvious takeaway is their incredible growth trajectory. Their revenue and profit growth rates are really something, especially in a competitive field like wealth management.
Absolutely. It seems like they've figured out a winning formula that's working really well for them right now.
But at the same time, it's important to acknowledge those potential risks we've identified. Those high valuation ratios, especially that PE ratio over 70, show that investors have really high expectations. Prudent Corp has to keep performing exceptionally well to justify those valuations.
It's a classic case of high risk, high reward. Investors are betting big on their future, but any misstep could send their stock price tumbling.
Exactly. And that leads us to another important point. the need to keep digging deeper. We've just scratched the surface here. To really understand Prudent Core's financial health and their future prospects, you need to dig into those investor presentations, read their earnings call transcripts, and look at detailed industry reports.
Those resources can provide those fine-grained details and the background information we need to assess whether Prudent Core can actually live up to those expectations.
Absolutely. They can help you grasp the company's strategy, their competitive landscape, and those key factors that will drive their performance going forward.
Okay, so we've highlighted the impressive growth, pointed out the potential risks, and stressed how important it is to keep investigating. Now, to wrap things up, let's try to pull all of this information together and offer our listener a final, thought-provoking question to consider.
Okay, here's one. Prudent Core is clearly doing well, but the question is, can they keep up this momentum while managing the risks that come with rapid growth?
That's a great question, and it goes right back to the listener's original goal of understanding Prudent Core's financial performance.
Exactly. It's not just about the numbers, it's about what those numbers tell us about their strategy, their willingness to take risks, and their ability to balance growth with long-term sustainability.
So let's dig into that final thought a little more as we wrap up this deep dive.
Sounds good to me.
It's kind of like they're walking a tightrope, right? They have to keep growing, but not get too risky. It's a challenge a lot of successful companies face.
Yeah, exactly. They got to keep moving forward, got to keep those revenues and profits going up. That's what keeps investors happy and the stock price climbing. But they can't get reckless and fall off the tightrope either.
So what are some of the things that could trip them up?
Well, we talked about a few already, like those trade receivables that keep going up. If they get too aggressive trying to win new clients by offering them more and more credit, they could end up in a cash crunch, right? Imagine if their revenue keeps growing, but they can't actually collect enough cash to cover their bills. That could put a serious strain on their business.
Like running as fast as you can, but going nowhere.
Yeah, that's a good way to put it. Another risk is they could get so fixated on growth that they lose sight of profitability. I mean, it's tempting to go after market share with discounts or by expanding into new areas, but that can hurt their margins if they're not careful.
And remember those high valuation ratios we were talking about. Investors are expecting a lot from Prudent Core. If their growth slows down or their profits take a hit, the market could really punish them.
No doubt about it. Their stock price is riding high on the expectation that they can keep delivering that rapid growth. Any sign of trouble, and investors might head for the exits, sending the stock price plummeting.
It's a high-stakes game for sure. They need to find the right balance between aggressive growth and managing risk responsibly.
Couldn't say it better myself. And that's where strong leadership and a clear vision for the company become absolutely essential. They have to make smart choices about which opportunities to chase, how to manage their cash flows so they don't run dry, and how to keep their balance sheet healthy.
Sounds like they've got a lot on their plate.
They do, but it's not all doom and gloom. They've got a lot going for them, too. Their track record is strong, they have practically no debt, and their management team has a lot of experience. That gives them a pretty solid foundation to build on.
Well, it'll definitely be interesting to see how they handle all these challenges in the next few years. Our deep dive has given you a good starting point, but remember, this is just the beginning. It's up to you to keep exploring and digging deeper.
I'd really encourage you to take a good look at those investor presentations and earnings call transcripts we mentioned. You can often find some really valuable insights there into the company's strategy and their thoughts on what the future holds.
And don't forget to compare Prudent Core with their competitors. How do their numbers stack up against other wealth management firms in India? Are they ahead of the pack or are they lagging behind? Those comparisons can tell you a lot about their competitive position and their potential for growth down the road.
You've got the tools and the knowledge now to come to your own conclusions about Prudent Core, their financial health, and what the future might hold for them. So go out there and do your own deep dive. And thanks for joining us.
Happy diving, everyone.